Hello, welcome back guys. In this video we are taking a look at TTWO Interactive, and it's a very interesting company to analyze a bit. We're going to go a little bit deeper in this one, so stay tuned, and I would suggest that you watch the whole video because you will see some interesting things in its cash flow statement. But let's start from the beginning. I suppose you will see that this company is actually 6% up the last trading session, and you will see if you take a look at like the 5 years chart that it's been going down kinda, potentially giving us a 35% discount here. I mean, that would be the case if it is a discount and if we're looking at an actual company that has enough value to actually sustain getting our money. So let's see what is going on first with the company's numbers here. But in case you are not aware actually what this company is, you can take a look at our company profile over here. You'll see that this is a very well-known company that basically is actually developing publishing games, for example. Offers its products under Rockstar, 2K, Private Division, and T2 mobile games names. It's a very well-known company that produces things like Grand Theft Auto here, one of the very big companies in terms of gaming. Now, okay, let's also go back and take a little bit of a closer look at our stock news. It's always useful to see whether there is something new coming for the company or some news that we need to be knowing about. And as you'll see here, it's for the most part talking about where the company will go to. Nothing in terms of news really, but mostly about talking the company's growth and whether they are promising and things of that sort. Okay, so all these things we can kind of very quickly take a look at with our tool here. Of course, remember that you can become a patron and get access to everything. And you will see here that the P ratio of the company is sitting at 85, and it's actually getting higher lately. And the price to free cash flow at 214, indicating that the company doesn't have a lot of free cash flow compared to what they are doing in terms of their stock price. That is interesting. We want to see what's happening here, and especially since this has been abruptly going higher. Well, what's the wrong thing here? In terms of outstanding shares, they are also been going higher. So the company is actually issuing some shares because they are taking advantage of the high stock price as it was getting elevated. And the company seems to be solvent enough. They have quite some free cash flow compared to the total liabilities. And judging from the fact that the free cash flow is not doing that well, it probably means that the company doesn't have many total liabilities. We will examine that, of course. The company has been growing apart from its free cash flow. Again, is a thing that we will see here, and we will examine that in more detail. As I told you earlier, it's an interesting case. Now, you will see that the margins of the company are rather low and dropping, and the returns are actually minuscule here. They're not good at all. So things are looking a little bit weird. I mean, it's the company looks expensive, and maybe it's not really making enough, and it's not utilizing its resources properly. Let's take a little bit of a look at the financial statements. Now you will see that 1.7 billion of revenue back in 2018 to 3.5 in 2022. That's pretty good growth here, of course. In terms of its net income, 173 to 418. Also growing its net income through the years, although it has done better some years ago. Now, in terms of the balance sheet over here, you will see that the total liabilities of the company are sitting at 2.7 billion and the total equity at 3.8 billion, with paid-in capital, of course, in between, because the company has been issuing shares, as we already saw, quite some as well, which is not a great thing, of course, for investors. But the very interesting thing, and the one that I wanted to kind of take some time and analyze a little bit, is what we're seeing in the operating activities cash flow over here, and generally speaking, the cash flow of the company. Now, you will see that the net income is 418 million over here, and last year it was 589. And the difference is vast in terms of the net cash from operating activities. And you may be wondering why that's the case, and of course the tool can tell you here rather quickly that there is a change in working capital that is very substantial here, about 700 million. So what does that mean? Now this can be a little bit daunting to understand what it really means. And I'm going to try to explain a few things about this one and what is happening right here with TTWO Interactive in this case. Now, when we're talking about change in working capital, what is working capital? you can kind of decipher what working capital is if you take a look at the balance sheet. And working capital is basically the difference between the current assets and the current liabilities that the company has. And so you can actually take a period of time like 2021 and 2022 and calculate that difference and see what was the change in working capital. And the working capital, again, is defined as current assets minus current liabilities here. Now the thing is, if you actually go back to the cash flow statement and do the calculation over here and get this value and then compare it to the balance sheet, you will never find the exact same numbers there. They won't match. That's very, very typical for companies. They never match. That has to do with grouping in terms of their balance sheet and how they are aggregating values and things of that sort. But it's going to be impossible for pretty much any company that you analyze. You can take a look at the actual forms and you will never be able to match this. But the thing is, you need to understand what is the difference between these changes and why they happen. Now, the thing that we can do, and I want us to do here, is I want us to go to use our tool and go to our SEC filings, and we will take a look at the latest 10K that the company has filed. Now, I have already opened it up. That is basically the annual statement of a company, right? And that is TTWO Interactive that we are looking at here. I have already opened it up. You can kind of see that this is the company. You can see net cash provided by operating activities. We are already in the cash flow. It's 257 over here, and 912 used to be the previous year, that is in years, like 2022, 2021. You can kind of see how they match over here in our tool. If you take a look at the cash flow statement, you will see 258, 912. And again, we go back to 258. Of course, it's rounded up a little bit for your viewing pleasure. But now over here, we can see what actually caused the changes. And this requires a little bit of thinking. Now, you will see some of the items. And remember, these are the changes in working capital. This is not the working capital. This is what changed. So this is basically the difference between current assets minus current liabilities as a change between these 2 years. And so this means that the company actually extracted some cash, because remember, these are cash flow items. So all about these negative values and positive values is about the cash flow, how much cash was extracted, pretty much. And so if you are looking at an expense here, like software development costs and licenses, you will see that we had a much higher cost over here in terms of software development costs and licenses, which means that this affected our cash flow, and it means that it affected our changes in working capital. And so this is why you're looking at the negative value here. And this actually gets translated to what you're seeing over here. We had a change in working capital. Basically, cash was extracted in order to change our working capital. And when we extract cash, we could actually be increasing the working capital. But the thing is, and the problem that can be happening here is that as we're extracting cash pretty much from the company, we're making it less valuable, potentially, less valuable in the eyes of an investor. Because there are problems with extracting too much cash from a company. The fact that it becomes less, how do you say, like liquid. They don't have enough cash to potentially grow, for example. And so this net income doesn't really translate to better operating cash flow, but worse, if we're taking a look at these kind of changes in working capital over here, which are very negative. And what I don't like to see is that the company is actually having quite some negative years in terms of the change in working capital. And you could always be expressing this as a percentage of the revenue that the company is generating, and kind of see what how this affects the overall how this affects the overall revenue of the company, the overall operations of the company as a percentage of its changes in working capital. Of course, you can do all this mathematics, but you can kind of very quickly see that here. And of course, by analyzing and taking a little bit of a look here, you will see what the company is doing. Like for instance, over here, you will see that there is a change in deferred revenue, for example, which means that the company right now is actually having less of a deferred revenue over here. So there is a decline in deferred revenue, meaning that the company actually got less money up front. So they actually got less money up front for services that will be rendered, that will be paid from the company, I should say. So will be serviced from the company in the upcoming year. And so this is not great because the company is losing some upfront cash, is the thing. Now, of course, it's part of the operations. You can never be expecting everybody to be paying upfront, but you can kind of see what this basically means for a company. These changes in working capital basically affect our cash flow directly, and also affect our working capital. Working capital, for example, the current asset could be the inventory. So as we are buying more inventory, then we're spending more money to buy this inventory. Now the change in working capital in this case would be zero. Why it would be zero? Because we are actually buying inventory, we're spending some cash, we're buying inventory without cash, but the change in working capital is zero because both cash and inventory is a current asset. So the change in current assets would be zero. However, we got extra inventory there and we got some cash flow to get extracted from our company pretty much. And so these things are all important so that you actually know what the company is doing with their money and how easy it is for them to use their cash to expand, for example. And when you are seeing these kinds of like negative changes in working capital, it's not the greatest thing really. Again, it has a lot to do with how the company allocates things, and sometimes a change in working capital could be negative and still be a good thing. But overall, I kind of don't want to be seeing too many changes in working capital in the negative, because they really affect our operating cash flow over here. And when our operating cash flow gets affected, then we're taking a look at the free cash flow that also gets affected quite significantly. And this lowers our valuation. It's going to be tougher for us to sell the company to the next investor, I suppose, at least for the current period, unless the company actually reverts that anytime soon. So interesting discussions, and of course this can be a much deeper discussion here in terms of working capital, but I kind of wanted to see you how you can actually take a look at the actual forms here and see the actual changes in working capital, what happened here, and you can analyze much deeper and actually see whether it makes sense and for you and for the company, of course, and whether you actually want to go with this, or if the company is actually paying too much money up front, or if they're actually getting paid too much money up front. So all these things, there's a balance for them, and it's useful to take a look at over here in using the forms that the company provides. Okay, so let's go back to our stock evaluation tool rather quickly. Now, you will see here that the revenue growth of the company has been at about 15%, although last year it was pretty minuscule, 3%. So we will go lower. We will go, let's just say 7, 9, and 11. And net income margins that we're going to be using, they are dropping quite significantly as well in the last 12 months. So over here I'm gonna go 8, 9, and 11. And the free cash flow that I'm gonna be using as a margin, typically the company makes more than 100. Let's just go 100, 110, and 120, and an annual return of 13% over here. We hit calculate, and you will see that we are far from where we want it to be. And remember that I also had some other concerns here about the changes in working capital, how the working capital is actually deployed here for the company, and also the fact that they are pretty expensive already, and they are still printing shares, things that I don't really like. And of course the working capital really affected the free cash flow. Now we'll see whether that reverts in the upcoming years or so, because this may have been a one-off, but these kinds of licensing costs here do seem to be going up pretty much every year, extracting cash over here. Okay, so let's go back, and yeah, this is what I wanted to talk about in terms of the company. I hope that actually helped you a little bit and kind of gave you some ideas about Take-Two. But if you did enjoy the video, please remember to leave a like and subscribe, and I'll see you in the next one. Bye bye.